What if I told you that rising foreclosures across the US was not the number one problem that bankers are concerned about? Despite what happened during the financial crisis and housing crisis back in 2007, 2008, there's something else right now that is very worrisome, and I'm going to show that to you in the first half of this video. What I want to do here at the Money GPS is give you the truth. I'm not going to sugarcoat it. I'm not going to make it soft. If you have the willingness, then you're going to get the truth. My name is David Quintieri, and I am here to bring you what you need to know, not what you want to hear. So if you want, let's get into it. You could see it for yourself. Home foreclosures are rising nationwide, with Florida, California, and Texas in the lead. You can see that this is affecting a lot of different places across the US. Cost of living in the US continues to climb, foreclosures also on the rise. Foreclosure-related filings, which include default notices, scheduled auctions, and bank repossessions, were up 7% from April and 14% from a year ago. I think I need to make it very clear that we are talking from a very low point. However, it is very obvious that when you increase borrowing costs, when you increase the price that people have been paying overall, as well as all of their other expenses going up, you're going to have problems everywhere. They can't pay their student loans, they can't pay their mortgages, they can't pay their car payments. Everything right now is increasing. Car payment delinquencies are increasing. Over and across the board, we are seeing this. But it isn't even on the radar of the bankers because something else is going on. Let me show you something first though. Look at this. The end of easy money, bankruptcy filings pile up at the fastest rate since 2010. A cleansing process long overdue to whittle down the corporate debt overhang and clear out the dead wood at the expense of investors. We're seeing this as well. I think that this is telling, very telling about what's happening inside the industry, that you look at a lot of these different companies and they are going bankrupt. All right. 5-month total, 286 bankruptcy filings is the most since 2010, more than double the filings in the same period in 2022, even outran the 262 filings that came in the same period in 2020. Now, what happened in 2020, of course, was kind of this hesitation. How long? I thought it was going to be 2 weeks. What's going on here? Is my business going to be shut down? Oh, we're getting a whole bunch of cash. Oh, I don't need to pay the landlord any money. Maybe I'll just hang on. Like, there was all that happening. Moratoriums in place, all these different things. So I could see how it would be lower in those years. These things are happening simultaneously. Okay, do you see that? The foreclosures, the bankruptcies, they've all picked up. This is not, if you can believe it or not even on the radar for what I will show you right here and now. Okay? Think about this for a second. Understand what happened with SVB gave us insight as to what is going on underneath the system right now. As we raise interest rates, we make everything more difficult. What am I talking about? Well, I'm going to show you something that I think everybody needs to understand right now. If you have the patience, if you'll sit with me for a minute, I will explain it all. There's more trouble coming for regional banks. Commercial real estate will pressure banks' loan books. Credit contraction is coming. Yes, this is essential to understand right now. The stock market isn't so worried, the way I see it, isn't so worried about what's happening inside of, these banks. If you look at tech stocks, that's the way I see it. However, lenders are still facing serious pressure. That's the point I want to note. A credit contraction is invariably coming. Why? I think it is very clear. They'll say it here. Let me cover it. One further source of trouble for the industry will be commercial real estate, an area that in recent years, smaller regional banks have become a bigger force in. That's what I'm talking about. That is very important. Working from home has cut into office values, and almost $1.5 trillion of commercial property debt is due for repayment before the end of 2025. I covered this in a video just recently. Have you seen that one? If not, make sure you subscribe and I'll bring you the latest updates as we go through that. Just click that subscribe button down below. Meanwhile, rising interest rates have made many properties less valuable. Uh-oh, that's where we get it. US banks have become much more vulnerable to a decline in commercial real estate prices. The upshot is that 700 US banks now exceed the FDIC's guidance from 2006 on commercial real estate loan concentration. Oh, therefore we're fine, right? No problem, yeah. Well, you can see where the issue is, and that is the smaller banks. And the smaller banks, you might say, well, they're, just the small banks. Those are the majority of the loans. Believe it or not, the smaller banks, not the big boys, the smaller banks are the ones doing a lot of these loans. And that's where things become a little sticky. You got to understand here, we're rising borrowing costs, increasing interest rates, and you got a lot of these companies like SVB that are holding onto these different assets. Remember, they have to pay out a return to their, to their people, their investors. How do they get that? Well, they bought some sort of asset a little while ago. Maybe that was 3 months ago. Maybe that was 3 years ago. And it's paying them a return, and then in turn they give something to their clients. Now, what if they were only giving a small amount? Well, if they're a smaller lender, if they're more obscure and so on, they're not going to do good business. They need to attract customers with a higher yield, better return. And so what SVB was doing was they were buying mortgage-backed securities. Okay, so they were buying these mortgage-backed securities, which, if you remember, in 2008 into 2009, they called this toxic. They would use that word. I don't see that anymore. I'm the only one I've seen that uses that word still. Toxic assets. Those two shouldn't be together. But a toxic asset, that's what they used to call them. And now what do we have? Oh, we have mortgage-backed securities. Oh, that sounds fine. That sounds fine. They're backed by mortgages. That's good. Well, here's the issue, is that we are seeing this compound. Because interest rates have risen, suddenly the value of those things they bought is not so good. And so they're left with all this garbage, toxic garbage, on their balance sheets, and they can't pay out their investors. So we have a concentration of that bad stuff right here and now. All right? So here we go. Some banks are already, if I go up to that, some banks are already shrinking their exposure to commercial real estate. This is one, PacWest, one of the US lenders engulfed in the commotion, is selling a $2.6 billion portfolio of real estate construction loans to shore up liquidity. The small minnows have the lion's share of the exposure. They have approximately 14% of their total assets in commercial real estate exposures, but it can be as high as over 40% of their total assets. I hope I'm making myself clear at why this is a big problem. We're talking about billions of dollars, many companies in different parts of the United States exposed at a relatively high level. And if interest rates get cut tomorrow, I don't think it's going to be such a big issue. But the expectation is that this is going to go on for a while. Do you understand here? If you need clarification, please let me know. If there's any aspect of this you want to know, just say it. I will make a video. That's what I've been doing almost every single day in the afternoon video or the evening video. When that comes out to you, that's based on a request from you. No other channel out there brings daily content that is specifically geared to what you are asking. It's unbelievable. It is like grassroots, crowdsourced information that I'm bringing to you. You just ask, you shall receive. Here we go. Regional and local banks are big lenders to the retail and offices. The worst stuff. I've been telling you this for years. Watch it, get away from it, don't touch it with a 10-foot pole, don't touch it at all. Regional and local banks are big lenders to retail and offices. The lenders are the biggest credit provider in each real estate category. Market share of lending in 2022. Here we have it. See it for yourself. I mean, that unfortunately is way too hot. That's way too high, and to me, that is very worrisome. Any further regional bank failures would likely make credit events more difficult to access for property developers and landlords, especially those who are smaller, of lower quality. That's going to be an issue. I mean, this is going to come up. The headwinds mean office values are down 27% on average from the recent peak after falling further in the past month. There's not much transacting these days because the buyers and sellers can't seem to agree on the pricing. These situations eventually resolve themselves, and it's usually in favor of the buyers, meaning there has to be a price drop. Do you understand this? The trouble is also beginning to feed through the commercial mortgage-backed securities markets, where about 140 billion of the assets are due to mature this year. That is not good. A rising percentage of the riskier loans were bundled into commercial mortgage-backed securities. 2022, look at that. Almost, what is that, 75% percentage of the loans underlying CMBS that are interest only? 75%? We've got problems, okay? Now, we can look into this further. I think it is very clear. I'm going to keep touching on this in future videos. All you got to do is subscribe to the channel and you're going to get the latest and greatest, okay? Nobody is aware of how really hazardous this is. You're talking about something that, quite frankly, is dangerous to the entire financial system, to the deposits that people have, to everything. Are they going to backstop the losses? Yeah, but how do they do that? With your taxpayer dollars, with quantitative easing, with bail-ins. That might mean the investors, or that might mean the deposits. I don't know. I don't know what they're going to do, but I want you to be protected, and I want you to know before it happens. So you're getting that information now. You had the willingness to learn up until this point, and you just got this information. How serious the data showing up right now for you, you can see it here for yourself. Let me show you some other aspects of this that I believe are very significant. Let's take a look right here. Park Hotels and Resorts announces cessation of payment on a $725 million non-recourse CMBS loan secured by two of its hotels. Here we go. What does that mean? They're not paying. They're not paying. This is $725 million. You got a problem. So what do? All these cases, they say, hey, we can't, I know we owe you $725 million. We can't pay that. But what we can pay is, and then they make a deal. Oh, we can only pay $200 million. We can only pay $150 million, whatever. So somebody's not getting paid back. Do you understand? This is the big deal right here. What about this example? They're just saying you got $97 million loan maturation as of March. Just 9.3 million of the loan has been paid off. So you see the problem here. I mean, it's crazy. All these different buildings, they're not getting paid. So the building's there, the lights might be on, somebody might be working in there, but the debt behind it isn't being paid back. And that's here where we have our issue. All right? If I'm not making it clear, please let me know, okay? I want to show you that the world central banks are approaching a critical juncture in their fight against inflation, with the route they'll ultimately choose set to impact the economy for years to come. The choice is between trusting the most aggressive tightening in the 4 decades will be enough to damp price pressures that have only just started to ease, or to keep going to ensure against concerns that 2% inflation targets are a thing of the past. That's what we're looking at right here and now, okay? And so my opinion right here, some central banks might go in one way or the other, but we are in a moment of, a real precarious position. Are they going to keep going on the tightening? Are they going to go backwards? Look at what Canada did. Look at what Australia did. These two central banks, they believed that, oh no, that was it. That was over. We're stopping. But then they increased again. Are they going to do that again? It's possible, because inflation just continues to go. So we'll see what happens in that example there. That's going to put, just like I'm saying, the reason I mentioned that, the commercial mortgage-backed securities, the debt that's behind the retail, the offices, this is really dependent on these interest rates that, quite frankly, they need to be cut fast, or they're going to be in big trouble. And by the way, commercial real estate, oftentimes it doesn't have that, like, you don't pay a mortgage off over 30 years kind of thing. Like, it's a short-term debt. So they have to worry real fast. HSBC among the UK banks pulling mortgage deals from the market. Banks have been repricing home loans to reflect high inflation. Interesting, right? I'd like to see where this goes. It's very early, but I just wanted to bring that to you because it is very related. And you could see the way that the market has been reacting, investors have been reacting, and individuals have been reacting. And that is, in this example, you can see deposits. The amount of deposits, I covered this in a recent video, are just flooding back in. So we're still off the peak, but 3 weeks in a row, deposits have increased. And that's just showing us, looking at it seasonally adjusted and non-seasonally adjusted. Either way, it's gone up, okay? You got to know something. You want to survive a market crash. You want to do, what you need to do at this time. You got to watch this video right here. Don't go anywhere. Just click this video and I'll see you there.